Today, we are diving into probably the single most overlooked, yet most important part of dividend investing, taxes. You see, the government can be a very expensive and very silent partner in your portfolio if you're not careful. So today, we're going to fix that.
Welcome to Wealth Print. I'm Wendy Pierce, and today we're diving into something that quietly holds most people back financially, even if they don't realize it. Here, we don't just talk about money. We break down the psychology behind it so you can make smarter decisions without overcomplicating everything. If you want clarity, not confusion, you're in the right place. Let's start.
You know, this quote right here, it really says it all. You can spend years building an amazing income stream, but if you're forking over a huge chunk of it to the IRS every April, what's the point? That is the exact problem we're going to solve.
So just picture this scenario for a second. We've got two investors, they own the exact same ETF. They get the exact same payout, but at the end of the year, investor A is smiling with way more cash in their pocket. Investor B, not so much. They lost a big slice of their earnings to a totally avoidable tax bill. The only thing separating them was tax strategy.
So how do you make sure you're investor A? Well, it all starts right here. You have to understand this one simple concept. See, when an ETF pays you money, the IRS doesn't just see it as money. They classify it in one of three ways. And that one little classification changes absolutely everything. First up, we've got the rock stars, the A-listers, the one you always want to see in your portfolio, qualified dividends. Think of these as the VIPs of income. They get special treatment, taxed at those much lower long-term capital gains rates. This is the absolute goal. Now here's where it gets really interesting. Just how low can that special tax rate go? Well, for a whole lot of investors, the federal tax rate they pay on these qualified dividends is exactly this, a big fat zero. Nothing. Zilch. And listen, this isn't some secret loophole for billionaires. It's written right into the tax code. For 2026, if you're single and your total taxable income is under about 49 grand, you pay zero federal tax on those dividends. And if you're married filing jointly, that number absolutely skyrockets to almost $99,000. This is an unbelievably powerful tool for building wealth. Okay, now for the bad guy, the one you want to avoid at all costs in a taxable brokerage account. Ordinary income. These are the payouts that don't get that special VIP treatment. Instead, they get taxed at your normal everyday income tax rate. And for most of us, that's a painful jump from 0 or 15% all the way up to 22, 32, or even 37%. This is the silent portfolio killer. And finally, we have the most misunderstood player in the game, return of capital, or ROC. Here's the deal. This money isn't taxed as income when you get it. The IRS basically sees it as the fund just handing you back a piece of your own money. So what it does is it lowers your cost basis. All that means is you get to kick the tax can way down the road until you finally sell. It's an incredibly powerful tax deferral strategy. Okay, enough of the theory. We've poured the foundation. Now it's time to actually build the house. Let's look at the specific ETFs, the actual tools that are designed to work best in a regular brokerage account with a laser focus on those all-important qualified dividends. Every portfolio needs a solid core, right? Your bread and butter. For the growth engine, we've got VOO, the S&P 500. Its yield is small, but its total return potential is huge, and almost all its payout is qualified. And for your dividend anchor, it's got to be SCHD. Great yield, amazing growth, and critically 100% qualified dividends. And with dirt cheap fees, these two are the heart of our strategy. All right, now let's build on that core. To add a bit more balance, DGRO is a phenomenal choice. It sits right in that sweet spot between growth and income. And for a reliable, diversified income workhorse, you can't go wrong with VYM. But what's the magic number we're looking for? Yep, both of these pay out 100% qualified dividends. Now, I get this question all the time. Can I get paid every single month? And the answer is a big, emphatic yes. Funds like DGRW and DIA are built to do exactly that, give you 12 paychecks a year. DIA, which tracks the 30 biggest blue chip stocks, is a super simple, no-fuss way to get that monthly income. And you guessed it, 100% of it is qualified. All right, buckle up. We're about to get into the advanced stuff now. This is a strategy that most people miss, and it can make a massive difference in how much money you actually take home, especially if you're tempted by those really high yields. So I know a ton of you own or are looking at high-yield ETFs like JPI. And why wouldn't you? That 8% yield looks incredible on paper. But there's always a but, isn't there? In a taxable account, there is a huge hidden cost. And here's that cost in black and white. This is the tax trap. Every single dollar JEPI pays you is taxed as that nasty ordinary income. So if you get a $50,000 distribution, you could be looking at an $11,000 tax bill. Meanwhile, a fund with a smarter tax structure like QQQI generates a much smaller bill and lets you defer a huge chunk of it. The difference is staggering. So, what's the secret sauce? How do you get high yield in a taxable account without getting crushed by taxes? The solution lies in a specific and, frankly, brilliant piece of the tax code. ETFs like QQQI and SPII are specifically built to use something called Section 1256 contracts to their advantage. Here's the magic. It doesn't matter if you've owned the fund for a day or a decade. The IRS automatically says 60% of the gains get taxed at that super low long-term rate, and only 40% get hit with the higher short-term rate, and on top of that, a big slice of the payout is often that return of capital we talked about, letting you kick that tax bill down the road.
Okay, theory's great, but let's make this super practical. We're going to put everything we've talked about together into 3 simple, actionable blueprints. All you have to do is pick the one that fits where you are in life right now. First up, Blueprint 1, Growth First. This is for those of you in your 20s, 30s, or early 40s. We're going heavy on VOO for that core growth, anchoring it with a solid 30% in SCHD, and then adding a 10% slice of QQQUI for that tax-deferred high-yield kicker. Next, we've got the Balanced Blueprint. This is perfect if you're getting closer to retirement and income is starting to matter more. We dial back the growth from VOO a bit, beef up our dividend anchor in SDHD, and bring in DGRO as that perfect middle ground player. It's a fantastic blend.
And finally, Blueprint 3, Income First. This is for when you're in retirement, and the portfolio's main job is to pay the bills. Here, we make SCHD the biggest piece of the pie. Add a dedicated income fund like VYM or DIA, and we bump up our allocation to those tax-smart high yielders like QQQI. This is all about maximum tax-efficient cash flow.
Look, if you walk away with only one thing from this entire explainer today, please let it be this. The single most powerful, most actionable tool you have for building a tax-proof income is the 0% tax bracket for qualified dividends. I mean, just look at that number one more time. For 2026, if you're married, you can have nearly $99,000 in total taxable income and still pay 0 federal tax on all your qualified dividends. If you're retired or in a lower income phase of your life, this isn't just a strategy, it is an absolute game changer. So I'll leave you with this one question. I want you to go look at your own portfolio after this and ask yourself honestly, is this thing built to work for me? Or am I just working to pay its tax bill? Is your portfolio truly built to let you keep what you earn?
Before you go, make sure you hit that subscribe button and join the WealthPrint community. Thanks for watching. I'm Jennifer, and I'll see you in the next video.